Okay, so let's have a look at the poll from earlier. You can see some responses coming through. What is the most important aspect you look for in a KiwiSaver provider? So I can see that we've got 79% who have voted performance, returns after fees, 2% low fees, 11% for ethical investment, 6% New Zealand owned and operated, and 2% superior customer service. Lucky that generates all of the above. We're going to run our next poll now. So this will pop up to the right. Where does most of your new business come from? The options are referrals, advertising, reviews, existing clients, or walk-ins. Submit your poll to the slider to your right. Next, I'll introduce you to Generate's investment team. The experts you can thank for Generate's strong track record. Over the last 8 years, Generate has built a reputation of strong long-term performance from responsible investing, active management, and our selection of world-class underlying fund managers. We're very lucky to have 2 of these fund managers join us later this morning. We'll now be running an investment panel based on questions received from advisors over the past week. So thank you to all the advisors who sent us questions ahead of time. If you have a question, feel free to pop in a question via our live chat. If you'd like to ask a question, ask questions during the presentations rather than at the end, as there is a 30-second delay with questions coming through. We might miss your question. We have with me today Sam Goldwater, lead portfolio manager who heads our international equities. Sam co-founded Generate with Henry Tung in 2012. Daniel Frost and Andrew Bolland, portfolio managers across Australasian equities. If you've tuned into the monthly investment webinars recently, you would have heard from Dan and Andrew recently. Ayrton Oliver, who is relatively new to the investment team, is the fixed interest portfolio manager. And Warwick Simons, our consultant in the global equity space, does a lot of research for the Generate scheme. Ayrton and Warwick featured on last month's investment webinar. Our team have a truckload of experience across financial markets, and as I said before, is the team you can thank for Generate's strong track record. You can check out their bios on the conference webpage for a bit more. It's great to see that we had a lot of ESG related questions, so let's start there. As advisors will know, ethical investing is becoming more and more important to KiwiSaver members. We are a market leader in ESG, as evidenced by Generate being a finalist in the Mindful Money Best Ethical KiwiSaver Provider Awards. So we are well placed to answer these questions. First question, how will Generate look to reduce its non-ethical investment percentages down towards 0? Let's go with Sam on this one.
Thanks, Wayne, and great to be here virtually with everyone today. So currently we have 0 investments in issues of concern from our direct investments. So the only way that we can further reduce investments that are deemed non-ethical by Mindful Money is by reducing our weighting to underlying funds further. As our investment team has grown, we have reduced our weightings to some of our underlying funds, and this will continue over time. Also, as the ESG wave continues to grow, and as dialogue with investors, ethical investors such as ourselves continues, it's hard to imagine that the non-ethical investments won't reduce in these underlying funds over time. Back to you, Wayne.
Thanks. Given the success of the Salvation Army housing bond, this is where Generate was the cornerstone investor. Are there other social impact investments on the horizon? Let's go with Ayrton on this one.
Thanks, Wayne. Yes, it was a great success, the Salvation Army bond, and it is great to participate in investments that have both a social impact and also offer an attractive return for our members. So on this front, we recently made an investment in Skyline Healthcare. So Skyline operates air ambulance services across New Zealand and the Pacific Islands. So this enables critical healthcare to reach more members of our community. We're also in the process of making a significant investment in a bond which will allow for a new primary school to be set up in West Auckland. So the investment, which includes impact reporting conditions in the transaction, will increase the availability of education, which is one of the UN's 17 Sustainable Development Goals. And back to what you touched on with the Salvation Army bond, given the demand for community housing, we are working with our partners such as Community Finance to explore other opportunities in the space, and we look forward to further investments here. So this also aligns with the Aotearoa Pledge, which we're a signatory of, which seeks impact investment commitments to finance community housing providers. So yeah, in a word, yes, there will be further social impact investments on the horizon.
What impact is the change from fossil fuels to greener alternatives having on returns for Generate's investors? And how has Generate decarbonised its portfolio? I'll give this one to you, Andrew.
Yeah, perfect. Thanks, Wayne. And it's a good question with two parts of it. And so I thought perhaps I could just start with an overarching observation that we can sort of go back to the basics of finance and valuation to gain an insight into what the impact of transition from fossil fuel to greener alternatives might mean. And so as the demand for the end product of companies that generate cash flows from fossil fuels or emission intensive activities declines, the riskiness of those cash flows increases. So Finance 101 would dictate that when a company's cash flows become increasingly riskier, then those cash flows should be discounted back to present day terms at a higher discount rate. In practice, what this means for a company involved in those activities is that their cost of capital is likely to increase as investors demand a higher rate of return to be compensated for the additional risks that they face. Conversely, we're seeing the opposite occur in the renewable energy space. There are currently large amounts of investment capital wanting to be deployed in this sector. For companies wanting to be involved in this sector, they're seeing their cost of capital decline and in turn their valuations increasing. So with that as a backdrop, I thought I'd just touch on some real life examples across Australasia. And starting perhaps with what's been my favourite in Tilt Renewables. Just very simply, Tilt was demerged from Trustpower back in 2016. It was at that point in time a 100% renewable wind generation developer and operator in New Zealand and Australia and listed on the NZX. It had a very successful track record of wind generation development and one of the largest pipelines of development opportunities in Australasia. In Australia. Generate recognised the potential value in this development pipeline quite early on, and ultimately through time became one of the largest institutional shareholders on the company's register. Late in 2020, Tilt's majority owner Infratil put the company up for sale, and after quite a competitive bidding process, Tilt was subsequently sold for around $3.3 billion, some 5 times greater than when it originally spun out of Trustpower. To put this another way, a shareholder who was there on day one in Tilt back in 2016 earned approximately a 40% annualized return year on year. To put that in context, the NZX 50 returned 14% over the same period. So this is a great example of the potential of returns in the energy transition. And then I thought I'd just touch slightly closer to home in terms of the New Zealand electricity generator space. We've got Meridian Energy and Mercury Energy, who are both 100% renewable operators. Since listing back in 2013, Mercury has actually divested its fossil fuel-fired generation. We've got Contact Energy, who's been decarbonising their portfolio, closing thermal plant, and has ambitions to build out quite a material renewable generation pipeline and ultimately exit thermal. Conversely, Genesis Energy owns a 46% share of the Kupe oil and gas field and operates the largest fleet of thermal generation in New Zealand. So looking back, say, over the last 12 months, what have the share price returns been for this set of companies? Well, we've got Mercury and Contact who are on their renewable path, having returned 27 and 25% respectively, whereas Genesis is somewhere around half of that, so I think around 13%. So it's just another way that we can see the changing fortunes of carbon-intensive activities versus renewables. And then lastly, I just thought I'd turn to decarbonising the portfolio. As you know, Generator are long-term active and fundamentally based investors. This means we seek to buy future streams of cash flows at attractive prices. As mentioned in the beginning, companies operate in carbon-intensive activities have an increasing cost of capital, which in turn is making those streams of cash flows relatively unattractive from both a valuation and an ESG perspective for Generate. As a result, companies like Genesis Energy, which I mentioned before, became unattractive to us. And so we divested that position in 2019. We've also divested our position in New Zealand Refining Company. That was some time ago. And more recently have been reducing our exposure to Z Energy. On the other side of the coin, Generate's been very supportive of companies that are decarbonising their own portfolios and or developing renewable generation. To this end, we've supported a number of equity and debt capital raisings, for example, from Contact Energy, Tilt Renewables, Mercury, and Infratil. And Infratil actually just announced last week a new venture into developing renewable energy assets throughout Asia. This sits alongside an already deep involvement in renewables in the USA and Europe. So as one of their largest institutional holders, we're really excited about this opportunity and supportive of their renewable energy investments. Thanks, Wayne.
Thanks, Andrew, for that detail. Currently, the focus is on unethical investment categories such as weapons, tobacco, and animal cruelty. However, are there concerns that investments into companies such as Facebook and Google, whereby there are potentially large ethical question marks around data and privacy, may cause problems around how ethical our investments really are in future? This one's for you, Warwick.
Great, thanks, Wayne, and good morning, everyone. Thank you for the question. I think it's a very good and very topical one in these complex times. I think with ethical questions, there are some situations where the nature of the business or the behaviour involved is just so egregious that it's very clearly not suitable for one of our portfolios. So you can think here, tobacco companies, weapons companies, or even companies that might have an ethical product, but it produces it in an unethical way, such, for example, a mining company that destroys the environment in order to extract minerals. In those circumstances, it's actually a pretty easy decision for us. We just don't invest. But then there are instances where the business and its operations are, on balance, good for society, but that some of the behaviour or use cases are not. And Facebook here, I think, is a fantastic example. For us, the fact that Facebook has billions of people, that's billions of people, every day using their products for free to connect with family and friends, there's real value in that activity. And that's especially important in times like these with COVID, where we cannot actually get together in person. And then the reason that billions of people get to use Facebook's products for free to connect with friends and family is that Facebook sells ads. And more than 100 million businesses use Facebook's tools to connect with potential customers and grow their business, often allowing the people behind those businesses to support their families. Most of the businesses that advertise on Facebook are actually small businesses, because they really see the value of reaching their customers for maybe $100 at a time or $1,000 at a time, rather than having to do a very expensive, large-scale national TV or print campaign. So we see both aspects of Facebook's business here, that that billions of people can connect with loved ones for free, and hundreds of millions of people can use Facebook's tools to better support their families. That's all clearly very positive for society. But we recognise that there are also challenges. Okay, with the scale of Facebook's business comes fantastic and great responsibility. And Facebook, in our eyes, hasn't always shouldered that responsibility well, certainly in the way that they should. They have allowed their tools to be used for nefarious means, such as selling drugs and human trafficking. A lot of that was reported in the Wall Street Journal over the last couple of weeks. And we believe they're also not policing misinformation on their platforms with the vigour that they should be doing. As shareholders, we don't approve of these failures on Facebook's part. And we're not silent about this. Just this week, we've been engaging with Facebook, that's Deborah Crawford and the investment relations team, to discuss these behaviours, relying on the back of these allegations that were present in the Wall Street Journal articles. Now, we believe as an investment team that these failures on their part are not intentional, and that in aggregate, Facebook products and the business is good for the world. But in these particular instances, the company needs to do better. And we've given them that feedback, and we hope that moving forward, they will do much more of that. So I'll leave it there. Thanks, Wayne, for the question.
And just staying on that theme with big tech, are there a few worrying stories So what we're seeing is that there are a few worrying stories coming out about Jeff Bezos' management style, which has been termed Bezosism. An example of this is tracking warehouse workers' movements, which automated warnings sent out if not reaching the expected quotas. Does this change our perspective on a company like Amazon as an investment? You may as well answer this one as well, Warwick.
Yeah, thanks, this one. Look, I think this is another example of a concerning report about a company and about potential behaviour there. But I think it's also, again, here important to step back and view the overall picture. Amazon's a massive company. Okay, it employs, I think it's 1.3 million people worldwide and 1 million people in the US. Okay, there's always, when you employ 1 million people, there's always going to be some stories of, potentially from disgruntled employees. And of course, the media loves jumping on the back of them and reporting them because it helps sell papers and gather attention online. But I think, as we did with Facebook, it's important to also look on the other side of the ledger here with Amazon. Okay, we can equally argue that Amazon treats employees pretty well. Okay, Amazon was the first major retailer in the US to offer a $15 minimum wage. I think that was in 2018. That, for context, is actually double the federal minimum in the US, okay, which is only $7.25. And they challenged, at the time Amazon went to $15 minimum wage, Jeff Bezos challenged their competitors, like Walmart, to match them. And now Walmart is actually matching them. Amazon's recent announcement on employee conditions is that it would actually pay college tuition fees for full-time employees starting next year. Now, in the US, where college is very expensive, this is a phenomenal benefit. And it applies to full-time employees with a 100% match and part-time employees with a 50% match. No other retailer like Walmart or Costco or anyone else offers these perks. Now, the reason Amazon needs to offer good pay and benefits is because it's growing so quickly and needs to hire a lot of people. And I think the fact that Amazon is able to do this, last year in 2020, it grew its workforce by, I think, 500,000 people. It's just a massive number. And the reason Amazon can do that is because on balance, it's a good place to work. So, while there are unfortunate stories coming out and the company I know is focused on them, we also, once we step back and realize the scale of Amazon and the fact that it's growing so quickly, it's not overly surprising. And on balance, we're very happy with our investments in Amazon. Thank you.
Thanks for that, Warwick. We'll move on from ESG now. What is Generate's view on private equity and venture capital? Should KiwiSaver providers be getting into these sectors? Would you like to answer this one, Sam?
Sure, thanks, Wayne. So my view is that KiwiSaver providers have an important part to play in both private equity and venture capital in the years ahead, as there will be fantastic investment opportunities that arise. And also a lot of Kiwis like to see their money going towards growing the local economy. We've looked at various venture capital investment opportunities in the past, but we decided that it was made sense to develop our expertise in private equity prior to getting involved in venture capital due to its higher risk profile. In the last year, we've made 2 private equity investments, the first in an unlisted property vehicle and the second in Skyline Healthcare Group, which, as Ayrton mentioned, is New Zealand's largest air ambulance service.
We've seen a KiwiSaver provider use crypto as an investment in their portfolio. What's your view on cryptocurrencies, and do you see this as a viable option for this type of investment? Why don't we start with Ayrton on this one?
Thanks, Wayne. Yeah, crypto is always an interesting topic, I think. Like the underlying technology of blockchain is very interesting and it's definitely being used in some pretty innovative ways. But I'd imagine most of us have seen the volatility and the swings in cryptocurrencies. For instance, Bitcoin was down about 18% in the last couple of days. For this reason, I don't have a view on where it's going up or down, but for this reason, the volatility means it's probably not suitable for an investment account, which has the sole goal of saving for retirement. And in addition to this, most cryptos have a lot of raft of regulatory and energy consumption issues that are piling up on them. Sam, do you have any comments on crypto?
I certainly do, yeah. But I'd like to add that Warren Buffett, who knows a thing or two about investment, has called Bitcoin rat poison squared, and his sidekick Charlie Munger has been even less complimentary about cryptocurrencies. But I would also like to make the point that we have no idea whether Bitcoin will go up or down in the years ahead, because it is impossible to value. And that is kind of the point. If you can't value something, then it is just speculation. And I firmly believe that speculative activities are not appropriate for retirement savings.
Sam, but it's been argued that cryptocurrencies offer important diversification because of their low correlation to equity markets. What's your thoughts on that?
Yes, I saw that. But betting on horse 5 and race 7 at Ellerslie also has a low correlation to equity markets. But that doesn't mean that KiwiSaver funds should set up an account with the TAB.
Okay, next question. How would you compare the dilemma of investing in local shares in the New Zealand share market and companies you know versus the opportunity to invest in offshore and large or emerging markets with better historical or potential growth? How about you on this one, Dan?
Thanks, Wayne. I'm glad someone asked this question. There are a number of compelling arguments for the inclusion of New Zealand shares in the portfolios. But before I give those, I think it's worth dispelling a few myths. Countless times I've heard people argue that the New Zealand economy grows more slowly than the rest of the world, and as a result, New Zealand shares offer unattractive returns. In my view, these arguments are simply not true. Let's review the data. Over the last 30 years, New Zealand's economic growth has comfortably outstripped that of offshore economies. Specifically, excluding the tailwind from a strengthening currency, New Zealand's GDP grew at 2.8% per annum, while the OECD only managed 2%. If we review shorter time periods, 10 and 20 years, New Zealand continues to outperform the rest of the world. New Zealand shares have also matched, if not bettered, the returns of offshore shares over the past 30 years, the longest period where total return data is available for New Zealand shares. Specifically, New Zealand shares generated returns of 10% versus 8% for global shares. Again, if we use shorter periods, the last 10 or 20 years, the returns are similar. New Zealand outperformed global. Now, of course, there have been some periods where local shares did not keep pace with their global peers, for instance, year to date. But this data confirms over long periods of time, New Zealand shares at least match the returns of global shares. On this basis, I'd argue that the New Zealand economy and its listed companies have comfortably matched their offshore peers. So now let's shift to some of the reasons why we find investing locally appealing. First, there is a clear tax advantage to the scheme in investing in New Zealand shares. Foreign shares are taxed like they pay a 5% dividend. Investors have to pay tax at the prescribed investor rate on a 5% return, regardless of the returns actually generated by these investments. Domestic shares are only taxed on the component of the dividend that is unimputed, which tends to be modest. Consequently, for clients with a taxable income of $70,000 or more, New Zealand shares have a circa 1% return head start on offshore shares. Second, we get great access to companies we invest in. This allows a good understanding of their long-term strategy and their ability to execute on that strategy. We believe making long-term investments in businesses that are well-positioned to execute on well-thought-out growth strategies will generate strong long-term performance. Before concluding, it is worth noting that there is a huge opportunity set offshore, and so I'm certainly not arguing that an investor should not have any money offshore. The portfolios have significant exposure to exciting offshore companies, some of which will be detailed later. I'm simply putting the case for the inclusion of a good weighting to locally listed companies. Thanks, Wayne.
Thanks, Dan. This question relates to the active versus passive debate. Why does Generate believe in active management, and why is Generate a pure active manager with the likes of no passive ETFs? Let's go to you, Andrew.
Thanks, Wayne. Yeah, it is a great debate, and if I could, I'd take up all the rest of the time, but I'll just try and keep it succinct. So Generate believes that markets don't efficiently price all assets all of the time. Active management allows an ability to take advantage of the times where the asset prices may not be priced efficiently. So there are plenty of examples of this, but I'll turn to my favorite, and that's sort of where we see ETFs playing in the NZ and Oz equity market. So the behaviour of exchange traded funds has grown increasingly prominent in the NZX and the ASX in recent years. ETFs, of course, periodically rebalance their index hugging portfolios. And this is because the indices that they hug are themselves periodically adjusting the constituents of the index. So whether it be a securities inclusion or an exclusion, an upweight or a downweight, we're never far away from some form of passive driven event. These events can and do materially impact the New Zealand market and can create quite significant price distortion from time to time. So for those that have read our monthly newsletters or have been on our webinars, you'll likely be familiar with the BlackRock iClean Energy ETF saga that began in December last year and played out over the subsequent 4 months. So on this forum, I'll spare the detail again, but this passive fund has essentially provided us 2 wonderful opportunities to profit from passive money flows. So it did occur across Meridian Energy and Contact, but I'll just focus on the experience of Meridian. So Meridian, an otherwise boring defensive electricity generator and retailer, had share price growth driven by passive money flowing into the ETF that made it look more like GameStop back in January. To be precise, in 50 days, the ETF bought approximately 50 million shares, which drove the share price up some 50%. Okay, so maybe not GameStop, but you get my point. As you'd expect, Generate was on the tools, and we were actively reducing our position into this strength and taking advantage of the opportunity at the expense of the passive and hapless ETF investors. And so what happened next? BlackRock then decided that the ETF construction methodology actually needed to change. And so, yeah, the reverse of what I just described played out. The same passive machine that drove Meridian's share price to stratospheric levels was now pointing the cannon in the other direction, providing active investors such as Generate the opportunity to almost perfectly round trip the whole event. So passive investors are an unfortunate victim in these all too frequent events, and they've really got little choice, barring exiting the funds that they're in, but to be in for the painful ride. Conversely, Generate invests on the basis of active management philosophy, where we're grounded in our fundamental research and are ready to take advantage of these opportunities where we can uncover them. And just lastly, I think ESG is an interesting angle on active versus passive. So our active management style neatly aligns with our ESG activities. Where needed, and fortunately and frequently, active managers have the ability to threaten divestment of the shares of corporates where it may be required. Passive funds, however, are unable to do this, as by nature, they're passive and don't have the same ability to just divest. So needless to say, we believe we can best maximise the returns for our members by continuing to deploy a grounded active management process. Thanks, Wayne.
What is a stock you've recently invested in or added to? We'll go with you, Warwick, and we'll do a bit of a circle with this question.
Thanks, Wayne. And it's actually good to play off a couple of the points that Andy's just talked about active management. This is where we actually get into the stock selection criteria. I think a good couple of stocks to talk about are Visa and MasterCard, where we have initiated and then increased our investments in them in the last few months. So Visa and MasterCard, fantastic businesses that take a tiny, tiny sliver of most digital payments around the world. So if you buy something for $100 on your Visa card, then Visa gets about 20 cents of that. There is in total of about a $2 or $2.50 fee, but most of that fee goes to your bank to cover for fraud protection and credit card points. And then the merchant's bank earns a small amount too. Visa and MasterCard are great businesses because they're growing well and they've got a lot of growth left to come as more and more of our business around the world is done digitally. And they're extremely profitable businesses as well because each transaction has no variable costs associated with it. So you've got 2 great businesses here with strong market positions, network effects that help them defend those positions, and a long-term growth trajectory ahead of them. Of course, this is actually pretty well known by the market as well. And in recent years, these strengths have been priced at a high valuation. But in the last few months, that premium has come down a little bit because there is a view of some people in the market that there is a threat from buy now, pay later firms like Afterpay and Affirm in the United States. We've looked at this threat in detail and concluded that we actually are not overly concerned about the threat that these buy now, pay later companies provide to Visa and MasterCard. And the main reason for that is that when you use a business like Afterpay, you actually still make a transaction on your Visa card or your MasterCard. It's just a different way. So what happens under Afterpay is if you buy something for $100, Afterpay pays that $100 to the merchant, and then over 4 payments of say $25 each, you pay using your Visa card, pay back Afterpay. So Visa and MasterCard actually still make good money out of it. It's just a slightly different nature of the transaction. So given that, and that Visa and MasterCard's valuation to come down, we looked at this market weakness as a great opportunity to buy some stock. And so we have been doing that in recent months. Thanks, Wayne.
Thanks. We'll hear from you next, Dan. What is a stock that you've recently invested in or added to, and why?
Thanks, Wayne. Chorus is the most recent addition to the property and infrastructure sleeve of the portfolios. It owns a world-class fibre optic network that connects Kiwi homes and businesses to each other and the rest of the world. Frankly, it is difficult to understate how lucky we are to be connected with such a high-quality data network. A quick look across the ditch at the hybrid compromise rolled out in Australia that provides households with poor data speeds highlights how fortunate we are. Given the quality of this asset, I hear you ask, why have you only recently added Chorus to the portfolios? Well, in our view, the share price of Chorus did not seem to incorporate two significant risks: regulation and alternative technologies. Ironically, as more certainty has emerged, Chorus's share price has also tumbled. Let's explore the two risks for Chorus and understand why they have receded. Regulation. Now, this is bread and butter to us. Andy and I run the property and infrastructure sleeve of the portfolios, and so we frequently think, discuss, and research regulated assets. But Chorus is a very different beast. Regulated returns are key for regulated assets. They prescribe how much you can earn off these assets. Normally, these are very well understood. This was impossible for Chorus, as the regulator was still in the process of prescribing these returns. The company, of course, provided its opinion on regulated returns, but unlike a number of other investors, we were hesitant to accept their claims. It is not unusual for companies to be overly optimistic. In fact, in our view, it's a good starting assumption. This gave us cause for concern. There was a significant risk that the company and other investors were overly optimistic on the level of regulated returns and thus Chorus's valuation. Over the last year, the company has moderated their view on regulated returns, which took a lot of the froth out of the share price. Then, as we got close to finding out the regulator's initial view on one of the key inputs, its regulated asset base, Chorus's share price slumped further. In our view, it started to incorporate a poor outcome, which allowed us to add Chorus to the portfolios. The second risk is alternative technologies creating bypass risk. Spark and Vodafone can either sign their broadband customers up to fibre and pay Chorus $45+ per month, or they can use their own networks with a fixed wireless solution and avoid paying Chorus. Needless to say, they aggressively marketed their wireless solutions using their networks. Fixed wireless does not provide the same performance as Chorus's fibre network, but some customers don't need this performance and are happy paying less. There is also a risk that others will be unaware of the performance differential and take the broadband product promoted by the telcos. Finally, it's worth noting that when the real 5G networks are rolled out, the performance of this solution will improve, closing the gap on fibre and expanding its addressable market. Again, in our view, the risk has receded. The Commerce Commission has made it clear that they are on the lookout for mis-selling of fixed wireless. Telcos cannot market it as fibre-like because the Commission's own testing shows that this is far from true. This focus should limit the proportion of households that will be sold fixed wireless. In summary, Chorus has great assets. Its share price has declined 30% from its highs, while other infrastructure stocks have continued to perform strongly. At the same time, the risks that Chorus faces have meaningfully declined. This has allowed us to add it to the portfolios. Thanks, Wayne.
Thanks. Sam, could you tell us about a stock you've recently exited from or reduced exposure to, and why?
Yeah, sure thing, Wayne. So as you would expect, we've been watching developments very closely in China, and decided that the landscape over there has meaningfully changed due to the heightened regulatory risk. As a result, we've materially trimmed our China holdings, our direct China holdings. We still believe our Chinese investments are high quality companies, but the elevated uncertainty in the environment that they operate in has changed, and hence we have made those meaningful reductions. Over to you.
And could you make a comment as well, Andrew? Is there any stocks that you've recently exited from or reduced exposure to?
Yeah, so I sort of alluded to them earlier, Wayne, and I just sort of caveat with that is that we invest for the long term, and often, and almost always with very high conviction, and so there isn't very large turnover in the P&I part of the portfolio. But yeah, I just refer back to the exit of Genesis, and then probably more recently the gradual reduction of Z Energy, which is sort of under a takeover attempt at the moment. So that's provided us an opportunity to reduce that position.
Thanks, Andrew. How does Generate balance KiwiSaver as a generally long-term investment with the commercial imperative for Generate to achieve strong short-term performance? Let's hear from you, Dan.
Thanks, Wayne. The good news is that I don't think we have a difference in focus. Yes, KiwiSaver tends to be used by clients as a long-term savings vehicle. It was designed to assist Kiwis to save for their retirement, and is indeed used by a large proportion of our clients to do so. Needless to say, this involves saving over extended periods of time. But we also have a long-time mindset. And at least from my perspective, short-term performance pressure is very limited. Our funds are invested with a business owner rather than short-term trader approach. Yes, of course, we take advantage of short-term opportunities, but this tends to be at the margin and is consistent with our longer-term view. This long-term perspective is also reflected in Generate's approach to advertising returns. We advertise long-term returns. Not only is this consistent with our investment approach, but it also aligns with where we think investors should focus. Specifically, investors should look through the noise of short-term performance and focus on longer periods. Thanks, Wayne.
What is Generate's view on inflation? Is it likely to be persistent and hence push interest rates materially higher? Let's hear from you, Ayrton.
Thanks, Wayne. Yes, it's a very interesting and topical question that. Something that's always on my mind at the moment, given the impact it has on central banks and long-term interest rates. So in general, I think the Western economy inflation, including New Zealand, is starting to linger around. So it's shifted from what was initially expected to be somewhat transitory and to become more and more persistent. There's two reasons for this. Firstly, the demand shock from the lockdowns has not been as bad as expected. This is because governments and central banks have come out with a lot of support, and this has led to some added pockets of spending across the economy. And secondly, the supply side constraints, which I'm sure a lot of us have heard about and read about, specifically on shipping. So these have not eased over the last 18 months, and it doesn't look like they're going to ease for the next couple of months at least. So these influences feed through into consumer and producer expectations, which ultimately feed through into prices. So for this reason, the inflation has become more and more persistent, and I believe this will see interest rates move a bit higher. But I think it'll be relatively small in magnitude. I could see maybe 10-year rates going around 0.6% higher, up to around 2.5%. And as we had all seen, the central bank is looking to hike interest rates in the short term, which is mostly priced in now for around 1% by the early next year.
Next question. Is higher than average fees part of Generate's success? How does Generate plan to replicate its fund's strong performance over the next 5 years? Let's hear from you, Sam.
Here's Wayne. So firstly, a big part of the reason that Generate has higher than average management fees is because of the underlying funds we invest in. As the weighting to underlying funds has reduced over the years, so have our fees. I would also point out that Generate doesn't charge a performance fee, which can really make a big difference to the total fees paid by the member after a big year of outperformance. In regard to the second part of the question, we've invested heavily into all facets of the business. As an example, our investment team has doubled in size since June of last year, and it will continue to grow at a solid clip. High quality people, processes and systems are what we need to repeat the strong long-term performance that our funds have notched up to date.
Okay, we'll have a couple more questions before we round up. A couple of questions from the advisors. Where does the New Zealand super fund play a part in the retirement planning for New Zealanders? How much of the shortfall will it cover? The reason I ask is because I have clients who want to know whether they need to increase the amount of their savings. Ayrton.
Sure, thanks, Randy. So the New Zealand Super Fund provides an important step, first step, providing retirement income for all New Zealanders. However, it's very likely the amount will not be enough for most lifestyles. So with that in mind, if you need anything above the amount, it's around about 400 a week for a single person. So anything above that is going to be required to be saved for by yourself. And the best way to do that is KiwiSaver. So I think KiwiSaver is perfect for this and realistically should be included in all retirement saving plans. For any additional savings you put together now, as Henry touched on at the start of the conference, by doing increasing your contributions or increasing your lump sums at beginning now, as it saves over the long period of time, by the time you get to retirement, you have this lump sum left over, and that will lead to greater returns per week. So, for example, if you're 65 when you retire and you have 25 years of retirement, each $100,000 will land you with $81 per week. So any addition you need over that 400 a week is going to be needed to save for by KiwiSaver.
Thanks for that, Ayrton. We'll have the final question. At what stage measurement of loss does an investment get replaced under our active management style? Let Warwick answer the final question.
Thanks, Wayne. I think here it's good to have a little bit of context. The future is inherently uncertain, and as investors, we're always looking towards that future, and we're making a series of risk-adjusted investments based on how we believe the future will play out. Our goal is to be right maybe 80% of the time. I think that's a pretty high goal, to be right 80% of the time, and then the gains from those times when we're right will more than offset any losses from the, say, 20% of outcomes that are different from our initial expectations. Now, this math actually takes a bit of time to play out, okay, because we are long-term investors, and because the math takes time to play out, that's why we prefer to discuss long-term returns over, say, 3 years or 5 years, and not to focus too much on the past few months. We're proud to say that Generate has a very good track record over those longer time periods, as Henry alluded to earlier. So then, when we look at those probabilities and how they play out, we've got many right in the last few years. Microsoft's done well, Alphabet's done well, Berkshire Hathaway has done well, but there have been areas of challenge. For example, our recent investments, our investments in China, as Sam mentioned earlier. The key in these circumstances is first off to focus on our thesis, underlying thesis for the business, and not price. Okay, so if price moves 20% down, but our thesis is still intact, well, actually maybe would be buyers rather than sellers. So we're constantly looking at our investment thesis and trying to work out, has that changed? Now, eventually there does come a point when if there is a massive reduction in share price, it actually gives us even more impetus to revisit our thesis and make sure that we're totally comfortable with it. And so when we look at those Chinese investments, for example, the reaction, the share price reaction shows how much the market is valuing the higher risk in China, and that has brought down the value of those share prices. And our response to that, as Sam said, has been to just pull back on some of our investments in China. That's an example of the 20% where the outcomes turned out to be different from what we were intending. Now, the good news is we can take that capital that we're taking out of our investments in China and reallocate that into some of the other ideas that we have. So, for example, Visa and MasterCard that I mentioned earlier. So that 80-20 sort of split is kind of the process, right? We expect to get most things right, and our track record is really good on that. But occasionally we do get things where the outcomes turn out to be different. And in that case, if our thesis hasn't changed, we stay. But if our thesis does change, we will divest some of that and reallocate the capital to better ideas that are performing well in our portfolio. Thank you.
Great, thanks for that. That was really interesting. That's all the time that we have for questions, unfortunately. Apologies if you've submitted a question via Slido. We didn't have time. We will circulate the questions with the investment team and send out any answers after the conference. So we will get back to your questions if you've asked one. Thanks very much to the Generate investment team. That concludes the investment panel.